Welcome to the Thursday edition of the Not Your Average Investor Show, the JWB Rental Income Property of the Week. Where today we're going to 11323 Dunn Creek Road in Jacksonville, Florida, 32218. That will deliver over 7% estimated return on investment, not including appreciation, is a brand new construction home, and is located within 6 miles of Jaxport and its 26,282 jobs. I'm ready to dust it off and kick it off because we are live on Facebook for the Thursday edition of the Not Your Average Investor Show. If you are looking to own rental income properties, you're in the right place. If you have a property in Jacksonville and you're looking for the best property management service in the world of Jacksonville, you're in the right place. And if you're a real estate professional looking for an edge in the Jacksonville market and an opportunity or two to make a little extra money alongside with your customers, you're in the right place. The next place to go from here is chatwithjwb.com. I am your host, Pablo Gonzalez. My co-host, the man that they call GC, because of his genius concepts, because he generates cash flows, and because he's a great co-host. Also because his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you.
Great to be with you too, buddy, for the JWB Rental Income Property of the Week. As you all know, this is a fan show. We got our family in the house. We got Lou Carlson from Somers, Connecticut. He's back. Greg Stone is back. Welcome, Greg. Leo from California. Good morning to you, my friend. Who else we got in here? Oh man, you know what? This thing shortcuts all the names, so I don't see it all perfectly, and then I don't know how to fix it. And this thing takes longer.
We got to have Bill Shields in here. He's here. He's here every week. I'm gonna take a flyer out there. Is Bill here?
I'm gonna guess that Bill's here with a Buenos Dias amigos or Hola amigos that he likes to say. Jennifer Filson's definitely in the house. Nadeem Shaw's definitely in the house. Robert Grayson is in the house. Who else we got? Let me see if I can.
That might be a new name. Robert Grayson.
Robert Grayson. That is a new name.
Welcome to the show,
Robert Grayson. I like the Grayson name. It's kind of reminds me of like a name from Game of Thrones or something like that. Grayson, right? It's very regal. Carl Thompson's here. Lee Bishop is obviously here. And then I got a couple of weird truncated names here that I can't say. Somebody that starts with an A, a couple other people that start with an I and L. Welcome, everybody.
They feel really welcomed here. Mr. and Mrs. A and I and L. You're just so, we're so happy you're here.
You know, hey, good to see you. Hey, happy. As you all know, this is an interactive show. We want you interacting with us. The first way to do it is in the chat. It's already happening. Good to see everybody in here talking to us and talking to each other. You got to change it to all panelists and attendees so that everybody else sees you. We'll get more into that as soon as I figure out how to use technology. And second of all, the Q&A. That is where you get to ask a question on the show proper. You bring it up on the Q&A. I ask GC. I may or may not weigh in on it. Depends if I'm feeling risky about it. And that is how you get to be Not Your Average Investor Show famous.
You're on a roll today. You really are.
You know what it is, Greg? I think this is, apart from this whole like ALI thing, this is the most comfortable I felt inside since we got the studio going. I love that you printed this stuff out for me. I love that we got the technology fixed. I love that we changed this. There's a new angle. Look how good Greg looks.
There we go.
Everyone, look how good Greg looks.
Wildly uncomfortable.
Wildly uncomfortable, as you normally are. But I know that you get real comfortable when we start talking about properties, Greg.
Oh, just get me going on Dunn Creek Road here.
Get you going down the road on Dunn Creek Road right here. This takes a little bit longer for me to actually share. So while we're talking about it, Greg, one of the things that we teased before the show is that this property is right by the port, which has a ton of jobs, and it's a major economic driver for the city of Jacksonville. And you're starting to get nerdy on economic drivers, man. Why don't you tell us a little bit about the port and why it's important?
Listen, I've been nerdy on economic drivers for a long time, right? Economic drivers, tax savings, those are pretty much my nerdy calling cards right there. You know, Jaxport has been a big deal for a long time, but it's very clear that what Jaxport is doing today is even more impactful, right? When you think about the major job creators of Jacksonville, you've got your military presence, right? That's the #1 employer. We've got 3 Fortune 500 companies downtown. But the port of Jacksonville is monumental for what we have already created. But what we're about to create and what is going on right now is even more impactful, in my opinion. So if you think about what's happening with the Panama Canal, the Panama Canal has been widened. And so it allowed for and deepened. So these bigger ships have been coming through the Panama Canal, and they're coming to the eastern seaboard. And all of the ports on the eastern seaboard have known this was coming for a long time and made those improvements to be able to take in those larger container ships, because when you take in larger container ships, that's more demand, that's more containers, that's more jobs, that's more economic impact. And the economic impact of these port deepening, channel deepening projects are huge. So every port has been in a race to get these projects done. But even before all of that good stuff coming, Jaxport is the second largest port in the state of Florida. It's the largest container port in the state of Florida, and it's the second largest vehicle port in the entire country. So you got this incredible basis. Now you've got this additional demand that is coming through this Panama Canal project that has already been completed. All these ships are coming through, and now all these ports are in a race to basically take that economic development and supersize it, right?
Yep.
So that's kind of where we are. We're on the precipice of a huge monumental step forward. And this harbor deepening project is really what I wanted to shed some light on here for Jaxport. Our waterway is 40 feet deep for the port of Jacksonville. The channel is 40 feet deep. To be able to house these larger container ships, you have to get to 47 feet. So you got to get to 47 feet. That is an incredibly important, difficult, costly project to go and take an entire channel and go from 40 feet to 47 feet. And actually it cost $484 million was the amount of the budget for that one. It's been, of course, fully funded. It's underway. But look at some of these stats here. So the project is currently 3 years ahead of schedule. I don't know the last project of this magnitude that's been run by major entities that is 3 years ahead of schedule. We are currently under budget. So under budget and ahead of schedule doesn't usually go into this type of a project.
Two things you don't normally hear in big construction projects and small construction projects alike.
Exactly.
Yeah.
So you've got this, and it's scheduled to be completed in 2022. So again, all of the things that we talk about as far as why Jacksonville is great from a cash flow perspective, from a future growth perspective, we've never really taken a deep dive on Jaxport. Like, it's all been current state or past, economic drivers, really.
Sure. We're
going to take a little bit of a step here and say, what can this do for Jacksonville's economic development just from the port? The port has 26,282 jobs today for Jacksonville jobs, 26,282 jobs. It's actually over 138,000 jobs when you go across the state of Florida, just from Jaxport. 138,000 jobs. And there's a $31 billion impact to the state of Florida just from Jaxport. So it's something that we haven't talked a whole lot about, but it is a huge driver. And then the property here on Dunn Creek that we're going to talk about, and really one of two of actually JWB's core neighborhoods, the north side in Arlington, are right smack dab right next to the Port of Jacksonville. And where do you think that those 26,282 workers who work those jobs live, Pablo?
I'm going to guess that they live somewhere close to the property that we're showing now, 6 miles away from the port, 11323 Dunn Creek Road, Jacksonville, Florida, 32218, in that north side neighborhood.
There you go.
There you go.
When you're trying to get excited about a rental property, you need to be looking at jobs. You need to be looking at that market, make sure that you have a solid, stable job base. And when you see less than 6 miles away, 26,000 jobs, probably a good place to be able to hold on to rental properties for a while.
Not a bad place, and growing, and economic impact that continues to grow with more and more things coming to the port, right? So it's 26,000 jobs right now. Tomorrow, who knows how big it'll be and how much more influence it'll be once this.
We're about to find out real soon. I mean, you're going to start to see the economic impact once this harbor deepening project is completed. 2022, right? It's almost 2022. Right?
Ahead of schedule.
2020 is in the rearview mirror.
That's
pretty
right.
much, we can look forward to 2022.
It's true.
Right?
We're closer to 2022 than 2020.
There you go.
Whew. I'm happy to hear that one, man. All right, Greg, let's dive into this property. So we're looking at this beautiful new construction home that is being built right now as we speak. I'm not going to ask if that's ahead of schedule and under budget, just because I don't want to step into anything.
It's definitely not under budget with the way the lumber prices have.
But I figured. But we're here at 11323 Dunn Creek Road. It's in the 32218, one of JWB's core neighborhoods, right?
Absolutely.
That 18. And it's at a purchase price of $245,000, 3-bedroom, 2-bathroom, 2-car garage, 2 or 3 year lease of $1,550. And then what the JWB investors like to come for is right here, this estimated conventional financing total monthly cash flow of $144 in the positive, and this estimated conventional financing total ROI of 7.44%. You know, Greg, I forgot to do something today.
What's that?
With a new tagline. If this is your first time joining, or you've joined us a bunch of times, if you go to JWBinventory.com.
Nailed it.
I questioned myself for a second. JWBinventory.com. You can download this spreadsheet right now that we're going to be fiddling with. And it is an interactive spreadsheet, so you can fiddle at home, just like I'm fiddling right now. So I recommend that you do that. And while you're doing that, bring the questions early and often. We're going to dive into these numbers right here, but we're happy to stop and answer any questions that you put up on the chat that I'm pointing to right here. Not the chat, the Q&A, hopefully, because this chat is really giving me a headache today because I'm having a hard time keeping track of it. But pop stuff into the Q&A and we'll answer it. But go to jwbinventory.com. You can download the sheet. You can play along, or you can just download it and save for later and watch Gregg's beautiful angle right here that we have a brand new angle of.
You are making me feel really uncomfortable. When you highlight the angle and you talk about how I look, that's really making me uncomfortable.
All right, let's talk about something else, Gregg, that I know you're comfortable talking about. What is this $144 of totally monthly cash flow represent?
This is the first reason that you're coming to rental property investing. If you're thinking about what to do with your money, you have some money, you want to put it in a great place to earn a risk-adjusted return, the best risk-adjusted return. The first part of that phrase there is risk adjusted, right? The way that you adjust risk down, one way that really matters is if you have monthly income coming in from that investment every single month. And there's not a whole lot of investments out there where you can get a decent return on investment and also have monthly income coming in. So when we look at this property here on Dunn Creek and you see an estimated $144 a monthly cash flow, what that's telling is you've got this wonderful investment opportunity that actually pays you every single month. Money comes to you after the expenses that a rental property incurs. And one of those expenses, and I try to drive this home every week because it's so rare out there, right? People say, oh, well, maybe I should be investing in the stock market or more traditional assets. There's no other asset class out there that you can get smart debt at the rates that you can today, be able to incur that debt on a monthly basis, and the revenue, the income on a monthly basis is higher than the normal expenses in addition to the debt expenses, and you've got extra income coming in every single month. And that's just gold, especially when you're holding on to an asset that has been shown to go up in value when you invest for a full market cycle. Like, that's just gold. And it's not gold because it's $100 or $125 or whatever the number is. The gold part of it is that it pays for itself every single month, right? People get so infatuated in maybe what this potential cash flow number can be. You know, an extra $50 of cash flow is not going to change your life, right? But what can change your life is making sure that you have an asset that pays for itself so that you might be able to get to 5 of them and to be in a market that has been shown to grow at more than the national average. That can really change your life 10 years down the road. But you can't get to that growth component until you take care of number one, which is positive cash flow. And that's what that $144 really represents.
There you go. Scalability, positive cash flow. We call this the table stakes, right? Like if you're going to be investing in rental income properties, I'm switching so that it's not just Gregg's amazing angle. You want to have it pay for itself and a little bit more. That way you can not be worried about coming out of pocket every single month. Something goes wrong, it goes terribly wrong, right? Like this, This allows it to pay for itself. I think it was Tim Hicks last week that said something along the lines of, as long as you're investing in positive cash flow, worst case scenario, a mortgage is getting paid for you.
Exactly.
Right.
You know, as long as you're investing in positive cash flow, right? You've got the positive cash flow coming in. And what he was also talking about is part of that positive cash flow is also your loan balance getting paid down by your resident every single month, which is kind of a hidden profit.
Yeah. That's a nice hidden profit center. We're going to talk about that right now. But first, I want to welcome, I finally fixed this chat thing. So I know we got Herb Francois. He's back. Welcome back, Herb. We got a newcomer, Deborah Seminario, coming in from Santa Clara, California, I believe.
Welcome.
No, San Jose, California, Silicon Valley. Very cool. Welcome, Deborah. And then I got a question here in the chat. I'm going to ask you all that if you are putting questions into the chat, please use the Q&A function. It just makes it way easier for me to find it and actually ask the question. So I may or may not miss it if you do. But before I lose that one, Shuki Graziani, welcome Shuki. That's a new name that I don't remember. And she asks, how long in average does it take for you to rent the unit?
That is a wonderful question. And, it's so much easier to answer that question today than it's ever been in my history of renting properties, right? Right now is the best time to be owning homes, either for the purpose of renting them out or, long-term, the values are going up and we see home price appreciation being more substantial in future years than you have right now. So either way, you're holding on to an asset right now that market values are poised to appreciate and rents are going up. And it's easier to rent today than it ever has been. For us, I was looking at our stats right before the show. We manage over 4,000 homes now. And I didn't even realize that we crossed that 4,000 threshold. Wow, which is pretty cool. Note there, we have this many homes that are longer than 30 days on market. We have 0 homes that are longer than 30 days on market, and we manage 4,000 of them. We have never had stats like that. We've been doing this for a while. We've been doing it pretty well for a long time. We've never had stats that great, right? It's gotten to a point now where we need to make sure that we start to market homes, even in kind of like a pre-listing stage, to make sure that our leasing team has homes to talk about, because there's so few homes on the market right now. Wow. And it's not like we're managing 100 of these, managing 4,000. So the last time I checked, the average days on market was somewhere around 12 days to go from the time that you actually list the home on the market to the time that you get, a deposit from a resident. And then they move in, 15 to 30 days, typically later than that. So, the stats are incredible right now. It's not always going to be this way, by the way. We're going to be doing this show many, many years down the future. And, it's not going to be possible to keep this up forever. I mean, you are just in an amazing time to rent homes right now because there's such a lack of supply. And it's all rental property investors right now.
Yeah. It seems like the asset class du jour, like all the macroeconomics, everything is happening for the golden era of rental property investing. I think it's awesome. I also think it's awesome that we got other people that I haven't shouted out. Jay Patel, Darwin Narvaez, good to see you here. Both of you guys I've seen you here before. Raja Bantu, also a bit of a regular. Andrew Barnhill, who's become a regular officially with us as well. Good to see you all. Let me see if I'm missing any more questions. In the meantime, Greg. So that was how long we get to rent, but let's talk about this total ROI, estimated conventional financing total ROI of 7.44%. How is that different than this $144 monthly cash flow?
Well, think of it this way, right? It's kind of like your entrance to the party is making sure that you have positive cash flow. That's what makes this thing scalable, and it reduces your risk to make sure that it's paying for itself every single month. However, when you hold on to your assets over a full market cycle, which is between 10 to 20 years, positive cash flow is not going to be your greatest source of your profitability. It's important because it makes it scalable and it reduces your risk, and you want to make sure it pays for itself every single month. But your greatest source of profitability over a full market cycle is going to be your other profit centers. Many people don't realize that. I think it's so focused on cash flow that they forget to pay attention to choosing the right market that might actually help them increase their overall profitability in the other profit centers. So that $144 is your cash flow, but it's slightly myopic by definition. It's only cash flow. There's 4 other profit centers. And when we start to look at that 7.44% return on investment, we're looking at the other profit centers. So the other thing we're doing is we're also looking at additional costs that don't happen every single month, right? So when we go to 7.44% estimated returns, that's us taking some additional positive things that are going to happen, and it's taking the additional negative things that are going to happen. And that's the best way to holistically look at what your money is going to do for you in the short run and in the long run. To be a little bit more specific, the positive things that we're talking about here are your estimated tax savings, which is the money that you don't have to pay Uncle Sam because you get tax advantages from owning rental properties. These are available to every rental property investor out there. You don't have to have a certain job in real estate. You don't have to make a certain amount of income. You are entitled to these tax savings that I'm talking about that are reflected here because you're a rental property investor. So it's an incredible opportunity there. It's your tax savings. And then it's also going to take into account your principal pay down, which again is something that every rental property investor gets to benefit from if you have a loan in place, because your resident actually pays your loan down for you. And that's why you'll wake up in 10 years and 20 years, you'll look at your loan balance and it might not be there, or it'll be significantly less. And that's real equity for you. That's real return on your investment. So you take those positive things. You also take into account some of the negative things that are going to happen. If you're a fan of the show, we talk very openly about the fact that you are going to have some negative things that happen to your portfolio in the form of maintenance cost, vacancy cost. You're going to have a resident turnover The longer that you own rental properties, if you've owned them for 15 years, like I have, you're going to have some resident turnover, right? You need to make sure that you account for those things over the life of your investment and put in cost into that structure so that your estimated return on investment is holistic. It makes sense, right? So you take into account your maintenance cost, your vacancy cost, your tenant placement fees, which is what you pay every time a new resident is put into the home. And you take all of those costs into account. You also take into account your closing costs, which are important when you're figuring out your return on investment. Take all of those negative things, add those, of course, into the equation along with the positive things. And when you put that over your initial investment, you'll find that it'll come out to right around 7.5% for this.
There you go. So the holistic picture of the assets and how it performs, right? You're taking in the other profit centers, the tax savings, the debt pay down, the cash flow, of course. You're also accounting for the negative stuff, which inevitably comes. It's not a regular occurrence, but it's so that way the usual monthly experience is the cash flow, $144. And these other things happen every once in a while. There was one thing that you didn't really talk about that I know is a profit center, Greg, and it's this appreciation rate. Do you take account in appreciation? Why does it say 0% there? Let's talk that through.
Well, it's great. And especially for some of the newer folks, it's so wonderful to have you all to be a part of the show. You might be asking yourself, as many new potential JWB clients do, Greg, if Jacksonville is a growth market, if you're telling me that things appreciate more on average here than they do in other cash flow markets out there, why do you guys put 0% for your appreciation rate there? And the reason is a few reasons. Number one, when you can put an asset in front of an investor that is risk adjusted, meaning it produces positive cash flow and it still produces a 7.5% return, like that's a win. If you compare that in the stock market, right? Over time, stock market produces somewhere around 7 to 9% returns on average over, full cycles, right? There's some variability up and down and whatnot, but people are usually going in there for the long haul, especially expecting somewhere around 7 to 9%. And they don't get monthly recurring income. They don't get income coming in. They don't get these other profit centers of tax savings and principal pay down and whatnot. So if you can put an asset in front of somebody that's producing 7.5% returns and you have monthly income, like that stands on its own 2 feet. So we don't have this huge desire or urge to go out there and fully show what the profit potential is. We like to keep that in our back pocket for you as an investor. Like, how cool would it be for you to sign up for a 7.5% return and the property goes up in value and you're like, wow, that came out to over 20%. Would you be pretty happy?
Pretty happy. It's something that you've taught me as why it's such an important core value for JWB to under promise and over deliver. It's because of adding those moments of delight, adding that experience that you can hit, but you can also know you can probably hit a little bit better. Yeah. Creates this customer experience that keeps people coming back, keeps the community alive, right? Like that's the reason why we have so many people that show up to our calls. Yeah. Is because you think about that throughout all of it. So it makes sense that, in your core product, you have that baked in at this 0%.
Exactly.
Yeah.
And I just think I think every business can benefit from that. If you just set expectations here and as a team, you probably know that you can be here. Whatever that is that you just did a little bit more for that client, that's what they're going to remember. You create this impression that clients get more than what they originally thought they were going to get from you. And that's what makes people smile. That's what makes people refer their friends and their family. So, yep. But I got a little bit off target with home price appreciation there, right? Yeah. So we put 0% there because the asset stands on its own 2 feet without us having to fully maximize what the profit potential is. The other part of this is that people don't really understand how to evaluate home price appreciation when it comes to making a decision on a rental property. So, when you go back to the great run up before 2006, from, 2001 to 2006, home prices went way high, very fast. And if you talk to anybody on the streets, they said, yeah, real estate never goes down in value. Real estate will never, ever depreciate. It will never go down in value. And then, I was investing in 2006. I invested at the very height of the market. That's when I bought about 40 rental properties. And then we all together learned the hard way that really made no sense. There's nothing that actually goes up in value all the time, right? And never goes down in value there. 2008 through 2011, the Great Recession happened. Home values fell over 35% in Jacksonville and across the country. So that theory was not solid. It was debunked pretty heartily.
Sure. But to your point, that cash flow was still happening for you during that time, right? Like that again, this is the whole ground floor thing. As the price of the home was going down, you were still netting cash flow and having a resident pay for the mortgage.
I was 23 years old in 2006. Like I borrowed a lot of money to be able to buy 40 rental properties with my business partners.
Yeah.
Right. Like there's no way that if I was cash flow negative on those 40 rental properties that I would still own them today. Right. I bought them with cash flow positive. I planned to hold on to them for a long time. And then my best plan was that I thought they were going to go up in value from the moment that I bought them.
Yep.
Didn't work out, but it didn't matter because I didn't need to sell the next day. And what I really knew and what I became very, very confident in is that real estate works in cycles. And so that's the big thing when you're thinking about home price appreciation. If you nail cash flow and you give yourself a long enough time frame, you're going to find that real estate does actually follow a pattern and appreciation rates actually follow a pattern. So this is the thing, in the past, everybody said home values went up all the way. They were wrong. Now we all are products of what happened in the Great Recession. And for those who don't know the data, they say, well, geez, I don't know the next time that home value is going to go down. And they say, I can't count on home price appreciation. And they say, I'm not going to factor that into my expected returns. And that's wrong too, because there are markets out here that have shown that based on population growth and other economic drivers that produce a higher appreciation rate on average than other markets out there. And when you start to actually compare the numbers of expected returns on investment and real returns, like real dollars in your bank account, what you find is that the biggest potential profit center is actually home price appreciation. You just have to be in for a full market cycle. That's that middle of the road approach that many people just don't understand. You can factor in home price appreciation as long as you're in for a full market cycle, which is known to be between 10 to 20 years.
Got it. So 10 to 20 years, full market cycle, that makes it predictable, right? Like as long as you have that spread where you're not going to get out too soon, you're going to hold it between 10 and 20 years, you can count on historical rates of appreciation. As we've shown multiple times on this show, even from the top of the Great Recession to now, we still can count on that historical rate of appreciation. So Gregg, what is the historical rate of appreciation for Jacksonville so we can show people how fancy this spreadsheet is that you can download at jwbinventory.com?
Since 1991, 30 years now, if you go and you look at the average historical appreciation rate for Jacksonville, it's 4.3% per year on average, which is substantial. Across the US, it's 3.6%. And in comparable cash flow markets, it's even less than that. Jacksonville actually is one cash flow market. And looking at the data, it has appreciated 34% more on average than those other comparable cash flow markets and 19% more than the US average appreciation rate. So that's when I say this is a growth market, that's what I mean. It's appreciated more on average here than the US and other markets.
So we got 4.3% put in the sheet. Once you pop in 4.3% on the sheet, you press enter. As we said, it's interactive to fiddle with. And now it jumps up to 23.07% appreciation rate for the asset in a real estate cycle. Gregg, can you explain why it jumped up? When I just put in 4.3, it jumped up 16%?
Absolutely. This is one of the most fun and exciting things about using smart debt on an asset that goes up in value over the long haul, right? Many people don't realize, but when you put debt on something, the market value going up is still your profits. But when you put debt on something, you limit the amount of your own money that goes into it. And when you think about and calculate what your return on investment is, it can really get supercharged. It can go way up in an appreciating asset. Again, that's why you got to be around for a long time to experience this. But smart debt on an appreciating asset can supercharge your returns. Specifically here, what I'm talking about is, let's just say that you have a house that you bought for $100,000 and you paid all cash for it. You did not use smart debt. You paid $100,000 for the house and it went up 4% over that year. If it went up 4% over that year for a $100,000 purchase, Pablo, how much is that house worth now 1 year later?
$100,000 bought in cash. It went how much?
4%.
4%. It would be $104,000.
$104,000. That's right. You earned $4,000 just from home price appreciation, not even talking about cash flow and some of these other profit centers. You earned $4,000 in return from home price appreciation there, right? But you put $100,000 to buy it. You bought it, right? For all cash. The way to figure out your return on investment from home price appreciation is you take your return, which is 4,000, divided by what you put into it, which is 100,000. So your return on investment from home price appreciation in that example is, which is great. But when you talk about what can be accomplished through using smart debt, it changes. And that's why this number goes up so substantially to 23%. If you bought that same property for $100,000 and it went up 4%, it would now be worth what, Pablo?
$104,000.
Nailed it. Just trying to see if I can get you, because I know you're busy wheeling and dealing back there.
I'm talking to the chat here. I'm keeping track of the Q&A. Again, if you're putting questions in the chat, you'd really help me out if you could put them in the Q&A. I'd really appreciate that. But continue, Greg.
So you made, again, financing now, you made $4,000, that same amount as if you bought it with cash. You still earned $4,000 if it's financed, right? It went from 100 to 104,000. That's your return on investment from home price appreciation. But how much did you put down? You put down 25%, which would be, Pablo?
$20,000.
25%? $25,000. Nailed it. 4,000 is not divided by 100,000 anymore. 4,000 is divided by 25,000 in order to calculate what your return on investment is, right? So 4,000 divided by 25,000 is actually 16%. And your return on investment from home price appreciation, because you use smart debt, is now 16%. And that's why this jumped up from, roughly 7.5% to roughly 23%. It's because of using smart debt on an appreciating asset.
There you go. Smart debt on an appreciating asset is one of the big under promise, over deliver kind of moments that as an investor you get. And it's not readily easy to understand until you've heard it a couple of times. So we like to repeat it on the show. For me, it took me like 6 or 7 times to be able to explain this and to be able to really bridge the gap between me telling my friends how awesome I think this asset class is to me actually being able to explain how awesome this asset class is, right? So it's the idea that you can put in, you can't buy a stock for 1/5 the price of the stock and then still get the same appreciation on the stock.
Exactly.
That is what makes real estate special. All right, man, we've got a bunch of questions in here. So we got 12 questions to go through. We got 25 minutes of time. I want to encourage anybody. We're going to go quickly through these questions. If you want a more detailed response, go to chatwithjwb.com, pick out a time to talk to the team. It is a completely informative call. They'll just talk about, what you're expecting and how to match your expectations to what you're trying to do. And first figure out if this is a good asset class for you. So that's the perfect place to go, because our boy Greg likes to give. So he'll go long. We might not get to all these questions, but
try reining me in. It doesn't work.
I'm going to try right now, Greg. So now we got 24 minutes and 12 questions. So
sweet.
Timer is on. Bing, 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 bing. All right, here we go. John Lilly asks, welcome, John. I don't think that's a name that we've seen before.
Yeah, welcome to the show.
Good to have you on the show. John Lilly asks, how much does one need to put down on a property like this?
Well, that's a great segue to Pablo. Perfect. Showing the spreadsheet that we so much like to fiddle with there.
Fiddling.
Right. So John, if you ever want to be able to answer this question when you're not here on the show, just go to JWB Inventory. You can always download the property evaluation spreadsheet, and you can change the numbers to reflect any type of down payment percentage that you want. So we'll give you the answer here, but for anybody else as well, this information is always available for you. Just go to JWB Inventory. So for this property, when you're thinking about how much you want to put down, I also want you to be prepared for what your closing costs are. And we make that really simple for you. In this property, 25% down is about $61,250, as you can see there. Your estimated closing costs are going to be another $6,000. So you're all in for about $67,375 for this property here on Dunn Creek.
Now, John, we tell you can fiddle with this thing, because if you want to put in 20% on this property, which is what I've done with the properties that I've invested in, put in 20%, you can pop it right into that spreadsheet and it'll tell you exactly the same thing, right? It'll be now a down payment of $49,000 and estimating closing costs of $61,225.
Yep. And we prepare clients when they come on board. When you do have that conversation that you set up at chatwithjwb.com, we're going to prepare you to expect between $50,000 to $70,000 for your down payment and closing costs for you to be able to purchase your first investment property with JWB.
All right. And we got Shuki is back. He's got more good questions. Shuki Graziani asks, thank you for the previous answer. When renewing a lease, do you list the property before the end of the current lease to ensure reduced vacancy rate? Is there anything on the contract with the tenant that is asking them to be available to show the property towards the end of the lease? Sounds like a property management question, Greg, something you love to talk about.
I love me some property management. Yes, and absolutely. And one thing I wanted to point out for those, if you're thinking that, you're interested in investing in turnkey rental properties, obviously you're in the right place, but there are a lot of folks out there that are just looking for property management services. This question is perfect. We get this one a lot on the property management side. And we do that for clients as well. So if that's what you're looking for JWB, make sure you hit us up and take advantage of that as a service that we offer. This question of, does it make sense to try to get a head start on renting properties out by, having an agreement, a contractual agreement, or an agreement with your resident that they're going to keep the home in a perfect shape and that they're going to allow people to be able to go in and see the home while they're currently living in it. There's more to be lost than gained is what we have established, right? When you have a resident who is interested in your area and your home from the outside, there's not a whole lot of vision that they want to have to like see past somebody else living in that environment. There's also not a lot of controls as to, are they going to pick up everything in the house before, right? There's also this incredible coordination and really not a positive experience for the previous resident. They're not getting a whole lot of out of this, not getting anything out of it to do it. So for all of those things, it's not something that we do. It's not something that we have seen. And as you can see from the stats that we're able to put up from a property management perspective, it's not needed, right? When you can rent homes in 12 days and you can fully maximize the chance to get that new resident coming in and seeing a home that is in perfect renting shape and also leave the previous resident with a wonderful experience and not inconvenience them, that's the win. That's just really what it comes out. It sounds better in theory than it really works in application.
Yeah. And, if you're a regular on the show, I know Shookie's new here, so we're happy to have him on board, but all of the decisions that JWB makes is something that I've learned comes from this giant data flywheel that they have. They've been doing this for 14 years. They have 4,000 properties under management. They track every number. You guys are always running experiments on what actually drives return on investment for your investors. You own 300 properties yourself, so you're testing on that as well.
Absolutely.
Right? So again,
that's a good point.
This is data driven.
We have done this.
Yeah.
We have tried this in the past.
Yeah.
We actually did this for a full year and tested it. I'm really glad you brought that up. And it made no impact. It made no impact. In fact, what we concluded is that future resident coming in, our stats today are much better than they were even when we were doing this. Yeah. So you lose that potential opportunity to close the sale with that new resident coming in. And that's most.
All right, Greg, reining you in. We got 13 more questions and 20 more minutes. All right. Shookie's got another great question. I noticed this property uses septic and well water. Does this mean that if there is no power for a pump, there is no water?
Oh, Shookie, you're asking like a really detailed question I have to know about septic and well. That's why I have an amazing construction team. So I'm gonna refer you to them. I do not know the first thing about how a septic tank actually works or wells. So when we get that particular, that's a great reason to reach out to my team. Go to chatwithjwb.com. I know how those things work enough to make sure that I can hit your return on investment on the property valuation, and beyond that for the specifics, I'm going to defer.
There you go. Educated investor. He's got great questions.
I love this. Thank you so much.
Here's another one. What type of furnishing does the property offer? Can it be customized?
What type of furnishing does the property offer?
So are you renting these things out furnished?
We are not. We rent these unfurnished and they rent very, very quickly. It's sort of the expectation in Jacksonville and Shookie. I'm not sure where you're from, but in Jacksonville, all homes that are rented, if you're thinking about like vacation rentals, many times they're furnished, but this is long-term leases. We sign 2 and 3 year leases. People are expecting these to be unfurnished, and that's how we do it.
There you go. All right. Another new name, Deborah Seminario. Welcome, Deborah. Question, is rent week in charge increasing since demand is so high right now?
Deborah, great question. Thank you so much for being on the show here. Absolutely. Rents are going up. Like I mentioned, it is a great time to be a rental property investor. So what we do is we have rents that we build in rent increases into your lease. As I mentioned, we sign 2 and 3 year leases, and the longer that the resident stays in the lease, the better the incentive they have to keep their rents to not increase. Like, for example, if you are a 2-year resident, depending on the level of your rent amount, in the second year, it's either going to go up $50 a month or $100 a month. And if you are a 3-year resident, that same thing is going to happen in the second year. But for a 3-year resident, we want to make this a win for your resident. We want to get them to sign up for that 3-year lease. So what we commit to them is that between the second and the third year, your rents are going to actually stay the same. You get a break on rent increases. And that makes sense to you, Deborah, as a rental property investor, because another year of not having to pay for a property turn is worth much more than keeping that rent stable from the second and
And she's got a follow up here. She goes above and beyond usual increase due to inflation, right? So is this like a tactic right now as the market is so hot? Like, are you increasing it more? I know that you're signing 2 to 3 year leases. Is there any extra space for higher rent increases?
Yes, absolutely. Rent increases, just like home prices, are driven by supply and demand and affordability. And we're an affordable market. So we're just going to assume that that's the case here. Supply and demand is what's driving higher rent prices and higher home prices. Over long market cycles, generally home prices and home rents stick to inflation. That's why we call it a hedge against it. So that's very real over a full market cycle. But right now, rents are going up a lot more. And that's because there's an undersupply of housing coming back from the lack of housing that was built after the Great Recession is the real source of all of this. And as rental property owners right now, we are all the beneficiaries of it. There's limited supply. And the data from John Burns Consulting, which is a consulting firm that we hire to give us data on rents, pricing, and whatnot, reflected 8% 8% rent growth in Jacksonville. So much higher than inflation.
8% rent growth in Jacksonville. That sounds pretty good for the owner of the property.
I like that.
Yeah, me too. So that leads into some questions that have been asked by Sir Robert Grayson and by I believe it's Shuki. No, not Shuki. Jen asked it. Deborah asked it. Right. What is the legal and advisable rent increase in this market right now? Like what are you stipulating for the rent increase? Is it that 8%? Is that what's written into the leases?
It is market driven. And so we don't limit your rent increases. Like, let me explain it a couple of different ways. So when your market or when your property would turn over, meaning that your resident leaves, there's no percentage increase that's going to get you to that next rent level, right? We analyze the market every single time and we see what we're renting in our same neighborhood, since we manage 4,000 homes just here in Jacksonville. So we're able to see, what did we just rent this home for last week that's right next door, right down the street. So we make that decision every single time that your home goes on the market. That's the way that you want to do it. Now, when residents sign a lease, there's a real value to tell them exactly what their rents are going to be and how much they're going to increase. Mm-hmm. And so $50 or $100 is going to be that increase in the second year for them. So we do kind of define it there because there's a big value there. And then again, there's a big value for you as the owner too, because when you have a resident staying in your home a long time, you defer maintenance costs, meaning deferring property turnover costs is what you want to do. You don't want to have those things every single year. So there's a win there. But when we don't have that, when we don't have an existing resident in there, we're going to see what the market bears. Because if we had limited that to 3% or 4%, we would be under renting a significant population of our homes for our investors and leaving a lot of money on the table for them.
Again, the value of that data flywheel, right? The value of having 4,000 data points of widgets that all look and perform relatively similarly in the same exact market. And that is what you are buying into when you're buying into here. Another great question from Shuki. He asks, what is the interest rate and terms calculated in the pro forma? Shuki, I'm going to do this one for you right here. If you go to jwbinventory.com and download the spreadsheet, you come right here and you see the interest rate at 4.1. And I'm going to take a guess here, Greg, that this is a under promise over deliver also by JWB, because I recently got a home, 20% down payment. I had a lower rate than that. And this is already estimating for 25% down payment.
Giving away all our secrets. Yeah. No, at 4.13 is what we feel really confident you'll be able to get as a down payment percentage. And, based on your own credit portfolio, you might be able to get less, but that's what we feel really confident about.
There you go. All right. Going back to the initial sheet here, and Gregg Stone. Welcome back, Gregg Stone. Great first name, by the way.
Love it.
Am I right?
Gregg's a client. Thank you so much, Gregg.
There you go. If there is a rental turn and the current tenant decides to stay, how does that affect their current rent? Does it jump to the current market rate, or is there a smaller step up?
I'm trying to fully understand the question. If there is a rental turn and the current tenant decides to stay, how does it affect the current rent? Gregg, I'm struggling with the question a little bit, because when we talk about a rental turn, that in what the way we talk about a rental turn, it means that the resident leaves. And then there's a rental turn, like the property turns over and we find a new resident there. So in that case, your resident wouldn't be staying. So I'm not sure I fully understand the question, but every time that there's a rental turn or a property turn, JWB handles that entire process for you. And then we go and establish what that new market rent will be for your home. And then that is absolutely the way that you want to do it. Sort of like the previous question was asking. So Gregg, if I don't understand your question exactly right, throw another one in there. We'll make sure we keep, what do we got?
We'll see. We'll see. We
got enough time for you, buddy. Throw it in there.
I'm going to rein it in for you. Oh, by the way, a lot of new folks here on the call. We have a Facebook group. You can find it at jwbfacebookgroup.com. We have almost 3,000 savvy investors in there. We've actually just made a couple of upgrades for it that we're going to be showing.
Yeah.
We've been tagging all the different parts of content so that you can search it better. It's a library, a great resource of information of stuff that we put out, but more importantly, the wisdom of the crowd, right? Like there's 3,000 other people just like you that want to get into rental property investing or have rental property investing, are in Jacksonville, are real estate experts. Super, super valuable. You can join the group at jwbfacebookgroup.com. So now we got Saori Bezoska. I hope I'm pronouncing that right. Saori, first and last name. Anyways, that's important to me. So let me know in the chat that I'm saying it right. And hi from San Diego, California, a city that I love, right? Like some, little spoiler. I lived in Southern California for a long time. I was real bummed to leave it, to move back to Miami. And it wasn't until moving to Jacksonville 3 years ago that I'm like back in love with a place like that, right? I call Jacksonville the Orange County, California 40 years ago in Florida, which is wonderful. So love San Diego. Welcome. Can you talk about the septic in terms of owner expenses?
Oh, Saori, thank you so much for being on the show. You have just set us up to talk about something that's really, a sore spot for many investors in a place where JWB shines. Normally, when you're talking about maintenance expenses and if you have a septic property, a property that's on septic and not sewer, if the septic tank goes out, that can be a $5,000 expense, a $10,000 expense. It can be a major expense. And as a rental property owner, when you're talking about cash flows of, like $100 a month or whatnot, right? You're not going to make thousands of dollars of cash flow every single month, right? So if you're going to make hundreds like we are, you got to avoid those big septic expenses or really any expenses in general. So this is definitely something to be prepared for. Well, JWB, for every new property that we sell, and this one on Dunn Creek is included in this, every property that we sell that's on that's on septic is included in our septic warranty program, which is incredible because if there's a major blowout of a septic system, it is covered under the warranty. The septic vendor who put the septic tank in is on the hook that it is not going to go out. And so they do regular routine, oh my goodness, I'm losing the word, checks on it, inspections, that's the word. They do regular routine inspections, which is great because then they're incentivized to do a great job putting the system in, incentivized to do a great job inspecting the septic system, make sure that the usage is right so that you're not going to be winding up with this $5,000 or $10,000 expense. So that is huge. That's how we keep septic costs low. But there's an even better part of this. You're going to see here on the evaluation that there is not a septic warranty fee. It's because the resident picks up the septic warranty fee as a part of their rent. And why does this make sense for the resident? Well, if you're on city sewer, residents pay their own utilities, right? If you're on septic, residents can be expected to pay for their own utilities as well. And that's the same, basically it's the same dollar amount that a resident would pay if they were on sewer. Now they're on septic, and that goes towards your septic warranty for you and as an owner to mitigate those costs. It's an incredible asset and one of the things that keeps our maintenance costs low.
Yeah. And sorry, that came out of, you can go back, I think it's maybe 3-4 weeks ago.
Yeah.
Melissa was here talking.
It's a little longer than that.
Maybe a little month and a half ago. They had this day at JWB where they kind of shut it down and asked everybody to come up with great ideas for how they can save costs and increase the ROI of their investors. And one of the crowd generated ideas was this like septic program that they've put into place. So there's a couple, if you look up Melissa, Not Your Average Investor Show episodes, you hear her describing that process in detail. All right, Gregg.
Well, and just one more thing. In the Facebook group, we now have all of our episodes tagged. And a lot of people ask about watching past shows or getting the replay of the show if you couldn't make it live here. you can go join the group, and then you're going to have all of those things right there for you. And you can just go and check out any episodes labeled. So another reason to join the group.
Another reason to join the group. I put it in the chat. Greg, we got 12 questions open, 8 minutes to go. Really about 4 minutes because we got to do our closing. All right, Carl Thompson. Welcome back, Carl. How many lots do you have in this neighborhood? Are you building more homes there?
Well, I don't know specifically about how many we have in this neighborhood, but I can tell you it's a lot. And I was just actually looking at our pre-construction inventory list with my business partners yesterday. We have 900 lots that are in pre-construction, meaning that they haven't been built on. And we only operate in 4 neighborhoods. So there's a whole lot in the north side neighborhood. There's a whole lot in the west side neighborhood, south side neighborhood, Northington neighborhood, hundreds.
It's a lot of lots.
A lot of lots.
John Lilly asks, what is the average interest rate on smart debt today?
Yeah, 4.125% is what we're telling our clients to expect. That's based on all of our lenders reporting to us on the rates today, as if you're putting 25% down. So,
all right, another great question from Sorry. Also, if I invest with JWB, am I locked into a contract that binds me to use JWB as the only property management company for my property as long as I own the property? Not that I want to, but I am concerned if I find myself unhappy about something at some point in the future.
Yeah, absolutely. I appreciate that question. I think it's really a healthy question to ask before you go into a long-term relationship. The answer is you have a 1-year binding agreement as your property manager with JWB. It auto renews. So if you don't say anything, then it continues to go on. At the end of the day, we talk to you on a monthly basis, your portfolio manager here at JWB, and we'll have a wonderful relationship. If at any point it just didn't work for you, you just let us know, and then that contract does not extend longer than.
Easy peasy. All right, Deborah Seminario. We got a lot of Californians in the house today. If we're just starting out, what is the impact on the ROI of having 10 100K properties versus 5 200K properties, or is a mix of each even better? Trying to decide what price to target as I'm beginning to build my portfolio.
Great question, Deborah. So a couple of things. When you're thinking about where to put your money, is it 5 or 10? Is it 5 low price properties or 10 low price properties or 5 higher price properties? The number one thing to pay attention to is your return on investment. And that is your job as a financial engineer, is to make sure you're putting your money to get you the best risk adjusted return. Beyond that, your example of $100,000 properties versus $200,000 properties, there's just no $100,000 properties in Jacksonville. If you want to be a passive rental property investor in a neighborhood that is going to produce the best risk adjusted returns, you're not going to find them for $100,000. So, but I'm going to kind of go a little bit farther than that. Let's just say that it was like, $200,000 versus $250,000 properties. Go with return on investment first, right? Beyond that, you'll want to look and make sure that you can get to a diversified portfolio as quickly as possible. There is real value in going from 1 property to 2 properties to 3 properties, because you want to make sure that you're coming to this asset class because of consistency. You want to make sure that you build a consistent portfolio, and consistency in your portfolio really starts with 3 financed properties. So number 1, focus on return on investment. If you have the opportunity to purchase lower price properties, especially as you're starting out, it's helpful for you because you get to that 3 finance property level quicker. And again, that 3 property level is so important because as you become more experienced rental property owner, what you're going to find is that you're always going to have some issues on your rental properties. Like, people like to think like, I'm just going to buy 3 rental properties, I'm never going to have issues. That's not the case. You're always going to have some issues with your rental properties. The thing that you need to do is to buy 3, get to 3 as quickly as you can, because you're going to have an issue with 1 most of the time. It's going to rotate. The one that you love the most is probably not going to be the one that you love the most the next year, right? The issues are going to show up, but you're going to have 2 other ones that are going to be overperforming. And ultimately, that's how we produce consistency of cash flows.
Great answer, buddy. That was really well handled. Greg, we got another minute or 2. So I'm going to pick out a couple questions here, but I encourage any of you, if you haven't had your questions answered, go to chatwithjwb.com. Again, informative time. You'll spend half an hour on the phone, ask your questions. It'll be just a getting to know you kind of call. Join our Facebook group so you can just ask him in the Facebook group as well. Greg goes in there. He answers questions all the time. All right. Her Francois asked a question. For a 3-year resident, don't you think you're leaving money on the table if you don't increase rents on the resident on the 3rd year? Yes, it's great for the resident, but not that great for a JWB investor.
Love that question, Herb. And this is a common thought for many investors out there. But as a rental property owner for 15 years, if I could just keep my rent stable with my residents, but I could just be assured that they were going to stay in those properties for 10 years or 15 years, I would win. Because when you actually break down the cost, and again, we just broke down the cost on Tuesday's show. So for anybody who wants to see the replay, you can go to the group, go look up Tuesday's show. We actually broke down what the costs are for a property turn. It comes out to about $6,000 for an average property when you count for the cost of repairing the property, when you account for the cost of vacancy costs, which is, the rent that you're not collecting because you have to find a new resident. And then you have to account for the cost of tenant placement fees, which your property management company will earn. It comes out to about $6,000. If you run the risk of increasing that to happen twice as often, you're never going to make up for that. And by getting an extra $50 a month of rent that may or may not, make a great resident mad, right? You're going to win long-term, even if you kept your rents the same, but you could just make sure that you increase the chances of them staying for 3 years, 4 years, 5 years. You're going to win, even if you got no rent increases. And so because of that, we want to make sure that it's a win for you, which it is for long-term residents. In order for you to get long-term residents, you have to make it a win for the resident too. You got to give them something. And so you're going to win a whole lot more by getting somebody to sign up for a 3-year lease and then keeping that rent consistent from year 2 to year 3.
There you go, Greg. We are up on time. Chad Willis asked a great question here that I can answer really quickly. If you're not on Facebook, where can you get the calls? If you go to nyais.com, that's notyouraveraginvestorshow.com. Both of those work, by the way, nyais.com or notyouraveraginvestorshow.com. You get the entire library of our past calls. You can also download it on the podcast. If you look up Not Your Average Investor Show on YouTube, you look up Not Your Average Investor Show on whatever podcast platform you like to use, you get all the past calls, all the past shows. And if you go to the website though, you also get blogs, you got a bunch of other cool stuff, right? And you can download this fiddling tool that we've been fiddling with today. Greg, great call today, buddy.
This is awesome. Thank you so much for everybody joining, all the new names and faces here.
Yeah. We had over 50 people on this call. We had a bunch of new names and faces. I hope that you will come back and join us. We never take it for granted that you take an hour out of your busy day on a weekday to hang out with GC and me over here. We enjoy it. We love getting the questions. We love interacting with you. We love messing with each other on camera, but I hope you come back. Really, really appreciate you being here. Tuesday, we are going into what it takes to get a great resident into your rental income property with Tasha Newton. Greg, you want to tell us about Tasha and what she does?
Oh my goodness. And so many great property management questions came from the audience today. Come back on Tuesday because you're going to be able to sit down with an expert who knows more about renting homes in Jacksonville than probably anybody else, right? We're going to be meeting with Tasha. Tasha runs our leasing floor. This is a leasing floor that signs over 1,000 leases, and they're all 2 and 3 year leases. And those residents that she puts in homes on average stay over 4 years, which means that she's doing an incredible amount of quantity, 1,000 leases. She's making it harder on herself and her team to sign 2 and 3 year leases because it's a whole lot easier just to sign 1 year leases. And she's doing an incredible job on quality because those same residents on average are sticking around paying rent and sticking around for an average of over 4 years. If you want to see how it's actually done and ask and sit down and bend the ear of somebody who is in the thick of renting in today's market, Tasha is going to be there. And she's an incredible asset to your returns on investment.
I'm looking forward to that one. She also, as I was getting to know her to warm her up for the show next week, she's a Navy veteran. She loved her time in service, and she has this really interesting kind of like perspective on leadership in the Navy, leadership in JWB, how she's able to apply them all. I'm really pumped to pick her brain. This is my favorite, Greg. I love the Thursday call. I love hanging out. This is like a family affair. We love it. We love hanging out in the Facebook group. Hope you join us there. It's an honor to be a part of it. Greg, I'll give you last words on ending this call.
Well, thank you all again for being here, making this so fun for Pablo and myself. One of the things I wanted to highlight here, and it's going to dovetail well into what I'm doing a little bit later today, is just the opportunity to work with other real estate professionals here in Jacksonville and across the country. There are wonderful ways that we can partner up to be able to help your clients, both from a property management perspective or from ability to find turnkey inventory right now. And it's not something that we highlight enough. So for any of those real estate professionals that are joining right now, thank you so much. I hope you come back. I hope you get some really great education. And then I hope you reach out to my team because there's a lot of ways that we can help grow each other's businesses. You can just set up a time, just just like we talked about at chatwithjwb.com. And I'm going to be, for anybody local here, I'm going to be speaking at JaxRIA, which is the local real estate investor association here in Jacksonville. So I'm going to be speaking there later tonight. We have a big event. And so I hope anybody who is local here will come on out and support JaxRIA tonight. And with that, brother, I'm going to be out next week. So I'm looking forward to a little bit of extra golf time for me.
I'm going to miss you, buddy.
I'm going to miss you too.
Oh, all right. See y'all, everybody.
See you, everybody.